So, have you looked at the economy lately and felt, well, a little confused? It seems like on one hand, the stock market's on an absolute tear, but on the other, you keep hearing these whispers about a recession. It feels like we're getting two completely different stories. All right, let's dig in and try to make some sense of what's really going on. You know, this quote from the legendary investor David Tepper just perfectly nails the mood on Wall Street right now. It's this feeling of reluctant optimism. He's basically saying that stock prices, their multiples, are really expensive and things feel kind of shaky, but the market is just moving up so fast that sitting on the sidelines feels like an even bigger risk. It's the very definition of a confusing time to be an investor. And that really brings us to the central puzzle we're going to unpack here. You've got the stock market behaving like everything is absolutely fantastic. The Federal Reserve just cut interest rates, which is usually just gas on the fire. And yet, at the exact same time, some of these classic old-school economic alarms are flashing bright red. So, what gives? Which story is the right one?
Okay, let's start with the good news, the bull case. Because honestly, on the surface, things look incredible. We are seeing a market that isn't just strong, it's hitting historic milestones, and it's pretty much all being fueled by one single transformative technology.
First things first, just look at the scoreboard. It's not like it's just one little corner of the market doing well. We're talking the S&P 500, the tech-heavy NASDAQ, and even the Russell 2000, which tracks all the smaller companies. They are all hitting record highs. This kind of broad rally, well, that's typically a sign of a very, very healthy and confident market.
And then, just to add more fuel to that fire, the Federal Reserve recently cut its main interest rate. Now, this is a textbook move, right? You do this to make borrowing cheaper to get the economy humming. For investors, a Fed rate cut is basically a giant green light that just screams, go!
And wow, the sheer scale of this AI boom is just on another level. This is not just hype anymore, okay? This is translating into massive, real-world deals. I mean, get this. Nvidia, the absolute king of AI chips, is making a stunning $5 billion investment in its longtime rival, Intel. And Intel's stock just exploded. At the same time, you've got companies riding that AI wave, like CrowdStrike in cybersecurity or the software company Notion, and they're reporting insane growth. This right here, this is the engine pushing the market higher.
But okay, let's pause the AI party for a second. If you turn down the volume and listen really carefully, you can start to hear something else. Something a little unsettling. Because just beneath the surface of all these record highs, there are some very different and much more troubling things going on.
And here's Exhibit A, heavy truck sales. We're talking the big rigs, the 18-wheelers that are the lifeblood of the industrial economy. Well, sales have just fallen off a cliff, down over 20% from where they were. Now, why should you care? Because for decades, this has been one of the most reliable predictors of what's coming next. It's simple. When companies stop buying trucks, it usually means they expect to be making and shipping less stuff. And historically, a drop like this has been a huge recessionary red flag. Now, to be fair, there is another side to this story. Some economists are saying, hey, wait a minute, maybe that old signal is just broken. They're arguing we're in this massive bricks to clicks transformation, where the whole economy is shifting away from physical stuff toward digital services and AI. So, maybe falling truck sales don't mean the economy is collapsing. Maybe it just means the economy is changing. And if you want a perfect example of just how weird and confusing things are, look no further than this. Remember that Fed rate cut we talked about? The one that's supposed to make borrowing cheaper for everyone? Well, in a completely bizarre twist that has experts just stunned, right after the announcement, average mortgage rates for home buyers actually went up. I mean, how does that even happen? So how does this deep economic divide actually play out for everyday people? Well, it is creating a tale of two very, very different consumer experiences, with a massive widening gap in spending power. Okay, on one side of the gap, you've got the high-end consumer. American Express jacks up its Platinum card fee to almost $900 a year. And people are paying it because it offers perks valued at $3,500. For this group, confidence is clearly sky high. And this high-end confidence is having a huge impact. The data here is just stunning. The top 10% of earners are now responsible for half of all consumer spending in the country. Half! That is the highest concentration in 30 years. This group is literally propping up large parts of the economy. But wait a second. Even within this confident group, we're starting to see a few little cracks appear. Take Darden Restaurants. They own everything from Olive Garden to more upscale places.
Well, their stock just took a hit because they admitted that even their fine dining business is seeing a little bit of weakness. But now, let's look at the other side of that widening gap. It's a completely different world. While some folks are paying for luxury perks, over 8 million New Yorkers are getting one-time inflation refund checks just to help them cope with the rising cost of living. The contrast is just stark. Okay, so let's try to put all these pieces together. We have a booming AI-fueled stock market on one side and a struggling industrial and Main Street economy on the other. How can both of these things possibly be true at the same time?
Well, economists have actually started using a new term to describe this strange environment: stagflation light. Now, stagflation is that dreaded mix of a stagnant economy and high inflation. This light version suggests we're seeing some of those symptoms, inflation that just won't go away, coupled with signs that the job market is beginning to weaken.
But really, the best way to understand this is to stop thinking of it as one single economy. It's almost like we have three separate economies operating in parallel. You've got the AI and tech economy, which is in a massive boom. You have the high-income consumer economy, which is still spending confidently. And then there's the industrial and Main Street economy, which is really feeling the pain of inflation and showing those signs of a slowdown. This is that bricks-to-click shift playing out in real time, creating totally separate realities within one country.
So what does this tale of three economies actually mean for your personal financial life? Well, it creates this really strange paradox between what you see in your retirement account and what you actually feel in your wallet.
And this is the personal contradiction I think so many people are feeling right now. You check your 401k, and you feel pretty good as it grows with that AI market rally. But then you go to the grocery store or you pay your mortgage, and you feel the very real pinch of inflation. So your net worth on paper might be going up, but your monthly budget is getting squeezed tighter and tighter. And this all leads to the final, multi-trillion-dollar question that, honestly, no one can answer for sure. Can the booming tech economy and the struggling Main Street economy just keep running on these separate parallel tracks? Or, at some point, is a collision between these two realities inevitable? That, right there, is the tension at the absolute heart of today's very confusing market.